Hello, everyone, and welcome to today's webinar, A New Way to Access Gold with ETFs. My name is Matt Hogan, and I'm the Chief Executive Officer here at insideETFs, and I'll be your host for today's webinar. We're in for a real treat today. Gold, of course, is the oldest investment on Earth and remains as relevant today as it was thousands of years ago. But people don't always understand how it fits in a portfolio and what they can do besides just sticking it in the vault and leaving it there. Today we're going to hear a new, innovative approach to using gold in a portfolio, a new tool that helps give gold some of the dynamism and opportunity that's been missing, a product that seems really well-tuned for today's age of quantitative easing, currency concerns, and other volatility concerns. Here to talk about gold and a new way to approach gold are two good friends of mine. Greg King, CFA, is the founder and CEO of RexShares, and Vineet Srivastava is Senior Director of Strategy Indices for Standard & Poor's. S&P is obviously one of the marquee names in the indexing world, and Greg, for those of you who don't know him, has a long history as being a real innovative leader in the ETF and ETN space, having led some of the most innovative firms in the area over the past decade. The format for today's session will be quite straightforward. Greg and Vineet are going to spend about the first 40 minutes or so running through a presentation outlining their new approach and talking about how this new approach to gold can fit into your portfolio. After that, we'll spend some time in Q&A, including answering questions from you, the audience. Before we get started, however, there is a little bit of housekeeping we need to run through. First, I'd like to thank RexShares for sponsoring today's webinar. We love this kind of big picture, insightful content, and we couldn't produce high-quality webinars like this without their support. Second, I'd like to consider you, the listener, to be a participant in today's webinar. That means that you can ask questions of the whole team here on the phone at any time using the Q&A toggle on your webinar browser. Please don't wait until the end of the session to ask your questions. Ask them as they occur to you. We'll collate them and answer as many as we can after the original presentation portion is complete. Third, if you'd like to enhance the viewing area of your slides, you may do so by clicking the Maximize button on the upper right-hand side of your webinar browser or by dragging and dropping the lower right-hand corner of the webinar slides. There's a lot of great information on these slides, and I know that the viewing browser can open a little bit small in the ON24 system, so I do encourage you to expand that window using either one of those two tricks. Fourth, because people always ask, a recording of this webinar and a copy of today's slides will be made available on the ETF.com website within 48 hours of the completion of today's webinar. You'll receive an email alerting you when that recording is available. This webinar is eligible for CE credits from CFP and CIMA, and the email you get alerting you that the slides are available will also contain information about the process for obtaining those credits. So if you're looking for those credits, sit tight after the webinar. We will contact you, and we will make sure that you will get credit for attending today's session. Fifth, if you like today's webinar, don't forget to sign up for our future webinars. They're available on the upcoming webinars window in the ETF.com webinar tab. We have a lot to cover in today's session. I've looked at the slides. I think they're fantastic. So without further ado, let's get this started. I'm going to turn it over to Greg King, founder and CEO of RexShares. Greg, go ahead and take it away.
Thank you, Matt. It's great to be here. Thanks, everyone, for joining. Good afternoon or good morning, as the case may be. And Matt, thank you for that kind introduction. I appreciate it. We're going to get started here right off the bat because, as Matt mentioned, we do have quite a bit of content for you. But before we do that, I just want to take a moment to give you an overview of RexShares. I think a lot of you are probably very interested in a new way to access gold, and maybe a lot of you have not heard about RexShares as we're brand new. But I do want to encourage you that the management team at Rex has over 30 years of experience, and we come from a lot of the places that you know and love, such as iShares and State Street and Barclays, Credit Suisse, and Global X funds. So we have a core team here that's been in the ETF business for quite a while and has launched over 75 products. And at that point, we've stopped counting. I want to give you just a little overview as well in terms of our setup as a company, because it's important as you look to research our products. So RexShares is an idea generation lab, and we focus on coming up with product that is going to deliver a more efficient or more effective existing market exposure. I know there's a lot going on in the ETF space these days, and you see a lot of thematic plays, you see smart beta type ETFs. You're not likely to see those types of things from Rex. Our focus is more on repackaging existing exposures that we think can drive a more effective solution for investor portfolios. As part of our overall setup, we've partnered with exchange-traded concepts to actually issue the ETFs. So every ETF issued by RexShares, you're going to see as coming from exchange-traded concepts. We did that because they're an existing platform with over $2 billion in assets under management, and that helps us to hit the ground running with our best ideas. Secondly, as far as the portfolio management of our ETFs, we're working with a firm based out of Atlanta, Georgia called Vidant Investment Advisory. They're an advisor running over $1 billion in mandates, and they actually trade the strategies. So what do? We come up with the ideas, we sponsor the ETFs, we put them together, and then we're responsible for marketing and distributing the products and speaking to clients and potential clients. So with that as a background, I just wanted to give you a little overview of the presentation today. And on slide 2 here, we see the first thing we're going to talk about is gold's role in portfolios. This is just a general reminder about why do we care? Why is gold important? Why is it in investor portfolios? What's the purpose of that? And just a refresher for why it's topical today. Secondly, we're going to look at our products, gold hedged equity ETFs. If you want to take a look at them as we're speaking, the tickers are GHS and GHE, George Henry Sam, George Henry Edward. And we'll go through what they are and how they're constructed. Next, we'll move into the S&P portion of the presentation, where Vineet will talk you through how his team created the S&P Dynamic Gold Overlay Index, how it's constructed, how it rolls, and what the mechanics are there. And then finally, because we thought it was important to give you some practical takeaways, we've put in a section called Case Studies. Now, these are hypothetical case studies. They're actually based on conversations we've had with clients and potential clients that we think will give you an idea of 4 different investor types that hopefully you identify with in some way, shape, or form, and how they might think through using gold-hedged equity ETFs. And of course, we'll end with a Q&A, give you an opportunity to ask questions, as Matt mentioned. So let me move into the next slide here. Slide 3, gold's role in portfolios. First off is wealth preservation. Now, this is the long-term reason that we believe gold is important in portfolios. You know, you might have heard of this analogy that goes around about how 1 ounce of gold can buy a quality men's suit, no matter if it's 2016 or the Middle Ages or even before that time. Now, I don't know if that's exactly accurate or not, but these days you can get a pretty nice suit for $1,200 bucks. So when you look at gold over the long term, it's usually in the same conversation that people talking about inflation. But if we look at the last 45 years since gold was unpegged from the dollar officially in the U.S., we note that gold is up on average a little over 8% per year. If we look at the stats from the Bureau of Labor Statistics, the CPI index is up about 4% per annum over those 45 years. Now, that does give rise to certain questions as to why gold seems to be outperforming inflation during that time, and that's perhaps a topic for another webinar. But at the very least, I think we can say, at least for that period, gold has utility as a store of value for wealth preservation and has kept pace with and even outperformed inflation. Moving down, the next way people view gold in portfolios is from a short-term perspective. So inflation being the long-term perspective, what's the short-term perspective? And that has to do with gold's safe haven properties. So what do we mean by safe haven? Well, there's a white paper written by Dirk Bauer and Brian Lucy entitled Is Gold a Hedge or a Safe Haven? It was published in the Financial Review. And they found a couple of interesting things. First of all, let me give you a couple definitions. When somebody says safe haven, what does that really mean? Well, in their case, it means an asset that is uncorrelated or negatively correlated with another asset or portfolio in times of market stress. So that's a safe haven. You can imagine people flocking to safe havens in times of market turmoil. They define a hedge similarly, but it's not in times of market stress. A hedge is defined as an asset that is uncorrelated or negatively correlated with another asset or portfolio on average, just generally speaking. They come to the conclusion, in fact, that gold is both a safe haven and a hedge with respect to much of the developed equity world. They also conclude that, by the way, gold is not a safe haven vis-a-vis bonds. I'll read you one sentence from their conclusion. It says, our empirical results show that gold is a safe haven for stocks. However, gold is generally not a safe haven for bonds in any market. Moreover, gold only functions as a safe haven for a limited period of time, around 15 trading days. What they go on to basically say is that people with exposure to gold in terms of market turmoil can experience the safe haven benefit of that if they owned gold already. But they found that purchasing it even one day after the start of the event was, on average, not a good idea. So, what does that tell us overall? That tells us that gold's role in portfolios has to do with diversification ultimately. Because you take those two characteristics and add them together and you say, well, if gold has an inflation hedging capability or keeps pace with inflation over the long term, and yet in the short term it can be both a hedge and a safe haven, that is to say, uncorrelated or negatively correlated with equities, then what that means is it's a diversifier for the portfolio. And as we looked at the past 25 years, we found that gold's correlation really oscillated between negative 0.3 and positive 0.3, with a median of essentially 0. So the question is, as an ETF investor, how can I get access to gold? Which I'm sure you all know the answers. We're here to tell you about the third. But let's just review the choices out there. And in this slide, we've taken and put the three types of investments together and compared them in terms of beta. At the top, you have your gold bullion ETFs that we all know and love. These products have been around for a long time, and they're very straightforward and serve a great function in portfolios. Their gold beta is clearly 1, and there is no equity beta. There's not an equity exposure in those instruments. We move down a line, and we see gold miners ETFs. And here, it's a more interesting situation. There is gold beta, but it's typically leveraged. It's greater than 1. And then there's equity beta, but it's typically deleveraged. It's less than 1. But there's also not just pure beta, there's idiosyncratic risk that comes into the portfolio via these investments in the form of a layer between the investor and the actual gold exposure, which is the management of the operating company. As we know, operating gold miners, depending on which, may not always operate the same way, and they do introduce a lot of variables that are fairly unpredictable. But now we have a third, and that is called gold hedged equity ETFs. And as you can see here, the gold beta is approximately 1. The equity beta is also approximately 1. So what is a gold hedged equity position? Okay, so on this slide, we try to illustrate, we try to use colors and shapes, try to be visual about it. But part of the point of this slide is to show you and to dispel a common misconception. A gold hedge equity position consists of an equity portfolio overlaid with gold exposure via futures. Now that sounds simple enough, but the initial conclusion a lot of people come to is that it's a 50-50 position, and it is not. Our goal within our fund, just taking GHS for example, would be to have the entire portfolio invested in S&P 500 related stock exposure, obviously on a long basis, and in addition to take long exposure to gold, to the price movements of gold via the futures market. If you think about that construct, it's very similar to currency hedged ETFs, where a portfolio of equities has a hedge applied in terms of a currency forward over the top of the entire portfolio. So the structure of the product is very similar to those, but in this case, you don't have a currency forward, you actually have a gold forward or gold future. Unless, of course, you consider gold to be a currency, which is another discussion, and lots of you on the call probably do. So the blue plus yellow equals green is meant to show that it doesn't equal a sort of 50-50 exposure, it equals more of a 100-100 exposure. If you move over to the right hand of the picture, you see a typical 60-40 type exposure. And say, for example, that was your portfolio and you wanted to take a view on gold to introduce that into the portfolio at a 10% level. Then you get the circle in the middle, which has the little yellow slice of pie there. The innovation here is that while that would require your equity position to go down from 60% to 50%, if you take a slice of the green pie, as it were, that's no longer the case. So gold hedged equity position means that you're still at 60% equities, you're still at 40% fixed income, but now you have a 10% gold position as a rider on the portfolio. And keep in mind that's possible because gold is a commodity and primarily trades in the futures market in terms of the notional volume that goes on. So we have the benefit of having the equity portfolio being able to support the notional gold position. Conversely, with a physical position, the entire proceeds that are used to buy that need to be allocated towards purchase of the physical asset and are not available to purchase equities or anything else. So in our view, this is a more efficient way to get access. There is obviously room for different approaches to gold in the ETF space. But the innovation here really is that no decrease in the equity allocation is required. This slide is basically reiterating those points. Why do it as an overlay? So we've talked a little bit about gold's role in the portfolio. That's why gold. And we've talked a little bit about what gold hedged equity is, but why as an overlay? Why not the bullion? Why not the gold miners? And really there are three reasons, or there's more than that, but we think there are three sort of common reasons. The first is this concept of capital efficiency. I just gave you one way of looking at it in terms of not needing to reduce equity exposure. Another way would be, for example, someone who has equity exposure to S&P 500 and gold exposure already existing in the portfolio. Now we're in a low interest rate environment. Everybody knows people are looking for yield. If those two investments were collapsed onto each other, or even a portion of those investments, then the resources that were freed up in the portfolio could be put to use elsewhere, perhaps in terms of the fixed income sleeve or in other alternatives. So it's a capital efficiency type of argument there. The second is gold, what we call gold productivity. So we do find that some gold holders are holding it really because they feel they have to. And the idea of plugging equity exposure underneath that gold holding, that maybe a sort of perma gold holding, makes them feel that they're making their gold more productive. And the third has to do with the safe haven properties here of just hedging. As mentioned before, the white paper provides that gold shows both safe haven and hedging properties. And so the idea of just kind of putting a little rider over the top of part of the equity portfolio to benefit from those properties can be one of the best arguments for why gold hedged equity investing versus the other methods of doing it. So with that, let me turn it over to Vineet, who will take you through the benchmark process and the methodology. Vineet?
Thank you. Thanks, Greg, and thanks, Matt, as well. Over the next 8 to 10 minutes, what I'll do is I'll walk you through the index construction, as well as we'll see some of the performance related sort of in the various times in the past. So it's a very brief agenda from my side. So just jumping in this slide, you'll see this is something that Greg actually mentioned in his comments earlier about the diversification of benefits of gold versus equities. So the slide just sort of, over the past 10, 12 years or so, it just shows you that effect. So what we're showing here is the S&P 500 and spot gold, and the 3-year rolling correlation between the S&P 500 and spot gold. So as he mentioned, the average correlation is about 0, but it varies in between like 0.35, 0.4 to almost negative 0.2. And what's also interesting here is that, as Greg also alluded to before, that the correlation actually moves in different parts, the market cycle. So you can see sort of 3 distinct sort of dips, right after the financial crisis, when you see some of the safe haven effects. You see a little bit around November in late 2011. That was around the U.S. Downgrade. And then obviously a little more recently when we've seen, actually in the past year or so, we've seen a dramatic lowering of the correlation between gold and equities. But for the most part, as you can see, when the markets were rallying, gold actually maintained a decent, the correlation stayed between 0.2, ramping all the way up to 0.4 as equities were rallying in the last 5 years. So just setting up the context for that, in terms of how this index actually works, again, going back to the example that Greg had in his slides earlier, the actual working of the index is very similar to currency-hedged ETFs. So we take up a long position in the S&P 500, and that position is overlaid with a long position in COMEX gold futures. So very simple. You have your 100% notional exposure to the 500 and 100% notional exposure to gold futures. So essentially you're getting the returns of both gold and the 500. Now when you take a position in gold futures, you need to worry about the roll. And so the roll here is important, and we'll spend a little bit of time just to explain how that roll process takes place and when the resets happen. So the index rolls in this case to the next gold futures contract. I'll actually show you the schedule of these contracts in the next slide. In the first 5 days of the month prior to the expiration of the contract. So if the contract expires in February, let's say, you're rolling into the next contract in the beginning of January, the first 5 trading days of January. So on each of those days, 20% of the notional value is rolled into the new contract. So why this is done? Why not over a day? Why over 5 days? I think it's just to make sure that there's ample liquidity and there is no, we're just trying to sort of minimize that impact. So just having that roll happen over 5 days is a lot easier in terms of managing those positions. The additional rebalancing that we do is mainly driven by the fact that you don't want, let's say one particular asset class is rallying way above one of the others. So we want to sort of pull it back within a certain range. It's kind of like the rebalancing back to sort of the 100% notional exposure to the 500 and gold. And that is done first thing every year on the first business day of September. So you balance out the exposure, the notional exposure to equities and gold. And it happens 2 other times. And in both of those times, what we are trying to do is, if the difference between the exposure of gold and equity goes more than 10% above or below, then it sort of normalizes that back to equality, essentially. And the other is again driven by performance. If the equity return and the gold futures return, essentially since the last rebalancing, start to diverge, much more to the upside, about 20%, or below 20%, below negative 20%, then we go ahead and reset. And again, this is just, there are benefits to rebalancing, and this is just trying to capture that rebalancing effect. Moving to the next slide, as I mentioned, with respect to gold contracts, I think the slide's a little, at least on my screen, looks a little offset, but just shows you the different contracts, that are available, the COMEX futures contracts. So as I mentioned before, the index rolls into the next gold futures contract in the first 5 trading days of January, March, May, July, and November. And again, as I mentioned, it's done primarily because of liquidity reasons. That's done on those days, and that's pretty much what that's all there is to it in this case. So moving on to the performance side of things, as we mentioned before, the performance is, as stated, there's nothing here that would be surprising given the construction. So when you look at the past, this slide shows you almost 16 years, close to 16 years worth of performance. And there are a few interesting parts within this that I wanted to point out. So you will see that, gold, obviously post-crisis, post the financial crisis, has had a pretty decent run up to, like late 2012, early 2013. And the index, because it has that 100% notional exposure to gold, it actually gets that return in addition to the return of the S&P 500 during that time. So it's effectively providing the return, the carry from gold, and the return from the equity position. Post 2012, or late 2012, I should say, you can see that equities kept on rallying in the last 2-3 years. Last year was an exception, and we can sort of drill a little bit in the next slide into last year's performance. But generally, you can see that equities kept on through the rally, while gold actually lost some of its value post its peak. But the strategy itself, as it states, it's a gold hedge strategy, so it is picking up the returns from the S&P 500 in that time frame. So very much as stated, the returns are coming from a combination of the returns of gold and the 500, and in various periods where it kind of demonstrates that it is effective in providing that diversification, whether whichever sort of instrument is performing the way it's performing better or worse. So the next slide just sort of gives you the numbers in more of a tabular format, and here you can actually see that as I was saying, over the whole 12-year time span, the gold hedge index actually returned 15.7% annually. The 500 in that period was about 7.5%, and the gold return was close to 10.2%. So again, as we saw in the chart and in the subsequent sort of index construction and the performance, it very much aligns with the fact that you are getting that full notional exposure to equities and the full notional exposure to gold. Obviously the math doesn't exactly line up as A plus B. There are certain strategy costs, if you will, but it's very much, in terms of, the annualized returns follow that sort of logic. Last 1 year, as I mentioned in my previous slide, was very interesting, especially in the past 3 quarters and 6 months, where we saw a pretty deep correction in the 500 and a rally in gold. So that's kind of the time that demonstrated the value of these kind of strategies. I mean, it's very hard to time, and when you see that the effect come in, if you were at the end of 2015 and gold had essentially taken the price of gold was actually falling as part of the slide that I showed earlier, and equities were essentially flat, you were wondering if that effect was essentially kind of not the same that we had observed in the past. But the last 4, 5, 6 months have demonstrated the value of actually staying in a hedged sort of position like this, whereas the market sharply corrected and gold rallied, the strategy was able to actually capture that effect. On a risk-adjusted basis, as you can see, the returns are quite attractive. The drawdowns are similar to the 500. As Greg mentioned before, the beta of this index is close to 1, so that's expected. And with that, I'll turn it back to Greg to take us through the rest of the presentation.
Great. Thank you, Vineet. Interesting point about the drawdowns. For sure. So as promised, we just wanted to finish up before the Q&A in running through a couple of case studies. And the idea here is to give you some practical takeaways. We're going to go through 4 investor types, and you may or may not identify with these hypothetical cases. But the idea is to focus on how these 4 types of investors might use gold hedged equity in the portfolio. So let me advance it to the first one, which we call the gold skeptic. Now, this investor has a healthy skepticism for investing in gold, probably for really any investment before it's parsed over pretty carefully. This investor is an asset allocator, believes the only free lunch is diversification, wants a diversified, low-cost portfolio. A lot of core ETF investors fall into this category. Current gold holdings are none. And the biggest concern about gold, obviously this is a little bit tongue-in-cheek, but it's just a dumb yellow metal. I heard Warren Buffett say that or somebody, and so that's the view. However, you can't argue ultimately with some of the correlation, diversification type of math. And so the consideration we feel for this type of investor would be the diversification and safe haven potential that a little bit of gold exposure in the portfolio could provide. And specifically with respect to gold hedged equity, in my experience, a lot of times the objection is really not about the risk-adjusted return potential benefit that comes from putting gold in. It's really about deallocating from a long-term investment. And so with gold hedged equity, there's no need to reduce the long-term equity allocation. This would allow the gold skeptic really to dip a toe in the water and see if they like it, see if it's warm. The second hypothetical case is what we call the reluctant gold investor. And I alluded to this type of investor earlier. This person is an asset allocator, also operating a diversified low-cost portfolio, but he or she actually has a gold allocation. The problem is they view it as dead weight in the portfolio, something like a drag, like insurance premiums, something you have to do but you don't really like it, and it's there because somewhere they got convinced that they needed to have it to avoid the awkward phone call from the client when they didn't have it, or who knows what the motivation, but it's there and they kind of don't like it. The consideration, I think, there is that gold hedged equity allows the reluctant gold investor to plug S&P 500 or, in our emerging markets product, the EM earnings power underneath the gold holding. So it's already there, sort of taking up shelf space in the portfolio, and a gold hedged equity approach would instead allow them to participate in the potential returns from the equity market. It also allows them to increase the gold exposure that they do have without reducing their long-term equity allocation. Thirdly, we have the real return investor. Now, these folks are of various investing styles and may or may not hold gold, but the key question for these investors is, can this investment help me preserve my true purchasing power for my client? Can it help me preserve wealth? For this person, the gold hedged equity considerations are similar, but we also added the point about hedging against the massive increases in money supply that have come over the last 7 years. We've all seen it happen. So far, inflation really hasn't showed up, and there are folks out there who believe it's going to come home to roost at some point in time. And so that would be consideration for the real return investor. And then finally, the gold enthusiast. So these guys love gold. They're opinionated. They take strong views. And this investor has gold ETFs, gold miners, and the main issue is miners have operational risks, and they want to get as much exposure to gold when they want to as possible. So the consideration here is obtain gold exposure over existing portfolio positions. For example, the S&P 500, the large cap equity position. This gold hedged equity allows the gold enthusiast an efficient way to kind of port that in. And they also would allow, if they were to remove their gold miner position, them to shed that type of a risk from the portfolio. So with those four, we thought hopefully you identify at least a little bit with one or more of those profiles. And I think at this point, we'd love to turn it back over to Matt and go into the Q&A. I'll leave you with a slide here on our funds. And of course, feel free to type in any questions or register on the website, send us an email, and I'll turn it back over to Matt.
Thanks so much, Greg, and thanks, Vineet, as well. I thought that was a great presentation. I do know a lot of people resonate with that second investor, or maybe that's the one I resonate with, where you feel like you need some gold exposure, but you don't think it's working hard enough, and this is a nice solution to that. So I'd remind the audience, as Greg said, that you can ask a question of Greg, Vineet, myself, using the Q&A tab at the bottom of your webinar screen. Just type it in, and we'll answer as many as we can in the time that we have left. I'm going to sort of group these questions, Greg and Vineet, from big picture to more focused on the specific products. So starting big picture, let's just talk about how you came up with this idea. What was the driving force, Greg? You left you'd done a lot in the ETF space. Why did you decide to make this your next big push with gold hedged?
Yeah, great question. Thanks, Matt. Well, I think this was many years in the making in terms of having this type of an idea percolate. But there are also some specific examples in the market, actually out of the hedge fund world, where you've seen a number of big-name hedge fund managers create gold-denominated share classes. They did this several years back and allowed people to participate in their hedge fund by buying dollar-based shares or gold ounce-based shares. And what that boiled down to is essentially a structure similar to this, but where the equity portion was their fund instead of the S&P 500. And of course, you have currency hedging strategies and overlay strategies that are very common in the institutional world. And coming out of that type of world, I personally just view ETFs as democratizing access to some of the more institutional exposures. If you think about how it all started with the S&P 500, it used to be really hard to trade 500 stocks at the same time, and then the spider was created. And so this is just the next evolution, I think, in the gold space as it relates to the ETF market. So it came from a whole lot of conversations over the years, but we really felt that this methodology of accessing gold in ETFs was something available to institutions very readily and something that ETF investors should have access to as well.
Great, love it. One question that jumps out staring at this slide is why S&P 500 and EM? Questions from the audience. What about sort of diversified international ex-US exposure? So what was the thinking in targeting those two markets, and are there more products to come?
Sure. Yes. Well, we definitely have more product ideas that we're working on, along the same themes. I think we picked the S&P 500 and emerging markets for two separate reasons. One, the S&P 500 is obviously the S&P 500. We wanted to start with the kind of the most middle of the fairway type of approach for the U.S. investing public, with really the idea that this was a capital efficiency type of argument. Folks could take that exposure, whether they were reluctant or enthusiastic, into their portfolio over the top of what is a very common holding in portfolios. As far as emerging markets, we actually debated some of the other geographical sectors of the world before deciding on emerging markets, and it really came from a white paper that was written by the World Gold Council several years ago that essentially puts forward the argument that using gold to hedge emerging market currencies is a decent proxy hedge. The idea being that emerging market currencies are typically have very high interest rates and therefore are very expensive to hedge directly. Most people don't do it, even though we all know currency hedging has been a huge topic in the ETF world for the last 3 or 4 years. And so in emerging markets, their research showed that a position in gold could sort of act as a proxy currency hedge, particularly for the EM space. And it makes sense if you think about it with respect to the safe haven properties and how EM tends to act in those types of environments. So that's why we went kind of with those two to start off, and then we're certainly considering and very open to suggestions from the audience as to what to do next.
Awesome. A couple questions spring off from that. So yes, hedging currency in the EM space is really costly. It's 8% a year in terms of headwinds. What are the costs of this product? Obviously, we have the expense ratio on there, but are there any costs or backwardation issues or other headwinds that come from adding that futures overlay?
Sure. So there are certainly transaction costs in terms of rolling that position and rebalancing that position. As Vineet mentioned, the benchmark index seeks to rebalance every 2 months, and so that would be certainly a cost that the fund would incur as it rebalanced that and rolled that. And depending on the volatility of the equity position versus the futures position, the gold position, there could be additional rebalances necessary. But I would see that as a kind of main cost. And then there is an implicit sort of contango, although it's not always contango, and sometimes it's backwardation. That is an implicit cost in the gold futures position. Since gold, though, is a financial type of commodity and not like oil, where you have to have all this physical these physical issues with respect to delivery in certain parts of the world, et cetera. The curve on the futures side with respect to gold is fairly stable and straightforward, and very much different than agricultural or energy type commodities.
Great. Okay, and what about tax? Are there any tax issues people should be aware of?
Yes, definitely tax issues. What we have to do on that one is point you to the prospectus because they don't like us getting into tax advice. I will say that the futures performance is operated by the fund in such a way as that the gold performance needs to be paid out as a dividend each year. And so that has some tax implications for investors, but definitely read that section of the prospectus.
Great. And your thought on how people will use this or how you're seeing people use this? Are they, let's say you have a 30% position in SPY. Are you suggesting they should replace that whole position with a gold hedged overlay, or are people splitting it, or what's been the use case?
Yeah, that's a great question. So taking a step back, I often have spoken to investors who feel either that they should own gold and don't, or they just own a little token position and it's not sort of moving the needle for their client portfolios. We spoke to one very large investor who has a 1% position. And they probably fit into that, number two investor that we talked about that you said you identify with, Matt. So the reluctant gold investor. So I don't know that, especially with a 30% position, we're certainly not making any recommendations that people, replace everything. What we are trying to point people towards is taking a look to see whether their investment in gold or their exposure to gold is at the level where they feel it should be from a risk-adjusted, diversified portfolio perspective, whether it's strategic that we're talking about or more tactically because of what they feel is going on in 2016. And then the question is, if it's not, why not? And a lot of times the objections center around, well, I don't want to sell out of this. I need to raise cash somewhere, and that's the problem. I don't want to take my allocations down in any of these other buckets. So that's the problem we're trying to solve with this. Ultimately, you don't need to physically fund the purchase of gold. Gold is a financial asset. The futures are extremely liquid, and we can take advantage of the benefit of that by using equity positions to support the gold futures position. And so the use case is really to augment or to implement a gold holding without sacrificing an existing asset allocation.
Great answer. This is a good question from the audience. How do you keep the spreads so tight on the products, given that they're new and are still establishing their volume? I'm looking right now, and GHS is just a few pennies wide with pretty good amounts on the bid and the ask. So what's the key to making that happen, and how liquid are these products for people who want to buy and sell them?
Well, that is a great question, and I appreciate that question and that you're noticing that. We actually took a lot of care in terms of how we constructed these ETFs in order for that to be the case, because we know that at the beginning, everyone wants to see volume and assets, and it's kind of a catch-22. So we wanted to make sure that even when we were just starting off and the products were smaller, that they would be well received by the market-making community, which ultimately translates into better spreads. And so what we did is the fund actually, I'll take GHS, the fund actually holds for its S&P exposure the Vanguard ETF mainly. And we did that so that the market makers would have a much easier time making their prices in a reasonable way. And just so you know, the management company Rex rebates that fee to the fund, so it's not you don't have an additional layer of fees there. But we just thought that was the best way to set these funds up at the beginning so that we would have those tighter spreads. And of course, ultimately, the S&P 500 is a very liquid universe. Obviously, gold futures, very deep and liquid universe. And really, other than a couple cash pieces and a couple other little bits in the portfolio, that's what investors, or I should say market makers, are really pricing, and that's why they're able to have those spreads, which of course we would hope would even tighten up over time.
Right. And if someone wants to, so there's about 5,000 shares on the bid side right now. If someone wants to trade more than 5,000 shares, what would you tell them to do?
So as always, and I think ETF investors know this, but we would encourage them to place limit orders, but also in our case, we're of course happy to point them to sort of arrange for them to speak to one of the market makers directly. And I know that many multiples of the size shown on the screens can easily be done because, again, the underlying positions are not difficult to obtain at all. It's not like we're talking about stocks in markets that are closed at the moment. Foreign, Asian stocks right now are closed. We're not talking about that, and we're talking about very liquid instruments underneath. So if they want to just kind of do it themselves, place limit orders, at or inside the spreads. Would be our suggestion, or go and give us a call, and we're happy to patch you through to market makers who would love to talk to you.
Great. We have time for about 2 more questions. This one you might not have an opinion on, Greg, but we'll ask it anyway. Was part of the driver of launching these products the huge expansion of central bank balance sheets, and are you hearing sort of concerns from your customers about that and a renewed interest in gold?
Yeah, good question. I think what's so interesting to me about these products is people come at them from 3 or 4 or 5 different angles. And again, back to those case studies, there's definitely a crowd who is kind of watching the monetary expansion over the last several years and just wondering how this is going to play out. So yes, that was absolutely part of the factor, or one of the factors in kind of coming up with these products. But really it was a long-term perspective that I had that, if I'm invested in XYZ index for the next 10 or 20 years, if it's in dollar terms, its performance is going to be a certain number. And if it's in gold terms, do I think that is going to be a higher number or a lesser number, ultimately back in dollars where my life is based. And so given the performance of gold over the last 40, 45 years, to me, the answer to that was fairly straightforward. And so it seemed like something that would be of value to the ETF investing public, especially because that strategy wasn't available before.
Great. We have time for 2 more quick questions. The second to last one is why gold and not other precious metals? Are those other precious metals not as good hedges as the gold exposure? You know what? I, in fairness, probably haven't researched that question enough to answer it. I will just tell you pragmatically that gold is the sort of lightning rod for this type of hedging and this type of safe haven and so forth. I know that silver and platinum, palladium can also be considered, and we've thought about that. It's not as if we haven't thought about it. But when you over-engineer something, a lot of times it just is a larger lift in terms of getting folks to understand it and get comfortable with it. Not to say we wouldn't look at something like that over time. I think it's a good question, but we're just not there yet. Great. And the last question, which sort of has 2 parts, is there anything else I should have asked that I didn't ask? And then secondarily, if people want to find out more about these products, what resources would you point them to? Sure. I don't know if I can pass on the first one. I feel like there's been a good number of questions, so I don't know if folks didn't ask anything they shouldn't ask. But on the second one, we have our website, rexetf.com. You have the S&P site where the methodology is available. S&P, I don't believe we have it up yet, but S&P has authored a white paper as well on this topic. That's very interesting. We will have that available soon on the website. It's not quite there yet.
And we also have a link to what we call our research website that also has different kind of gold-based themes and so forth that are not directly speaking to the products, but we're trying to build a library there that people can go to get some resources, and we'll continue to build that out. We're, as mentioned, just getting started. So hopefully that helps people in answering those questions.
That's great. That's great. And yep, go right ahead, Vineet.
Yeah, I mean, just on the website is up and running. So you can just go into the search box and type S&P 500 Dynamic Gold, and you'll get there. The white paper just got published, actually, so it's linked into that index page under additional info. So you can take a look at that. There are monthly fact sheets, so you can see the performance up to the last month. So you can see backdated history up to 10 years on those fact sheets, and the methodology as well. So that's
fantastic. That's fantastic. And if you have any trouble finding that, I'm sure if you email info@recsetf.com, they would be happy to make those connections to you. They also have a sign-up page on their website if you want to stay in touch with all of the Rex news. Their website, of course, www.recsetf.com. That takes up about all of our time. Greg and Vineet, I really want to thank you for the great content on today's webinar. It's unusual to get a new product that casts such a new way of thinking about core exposure, much less one that really does resonate in today's market. I really enjoyed learning more about the products, and I'm sure the audience did as well. I would encourage them to go to the websites and read up more or ask questions if you have additional questions. I'd also remind everyone who attended today that a recording of today's webinar and a copy of the slides will be made available on ETF.com within 48 business hours of today's webinar. So as a participant in today's webinar, you'll get an email either tomorrow or Monday alerting you when those slides are available. And that information will also, that email will also contain information on how to qualify for CE credits for today's webinar. I know everyone on this call today is extremely busy. I really appreciate you giving us an hour of your time. I thoroughly enjoyed it. I hope you did too. For now, I hope you have a great rest of your day, an excellent rest of your week, and a profitable 2016. This is Matt Hogan, CEO of insideETFs. Thanking you for coming to our webinar and hoping to see you again on a future webinar. Thanks, Greg and Vineet. Everyone have a great day.